Welcome to Barchart's weekly series of webinars designed to educate you on a variety of market concepts, inform you of tools and pages that Barchart provides, and the relations to these ideas, and finally, some guidance to help you make a more informed investment decision. Today's subject: how to tell if we're in a bear market. Now, did you know that there have only been two corrections of 20% in the last 5 years? Now, though technicians generally define a bear market as prices falling greater than 15 or 20% from a recent high or an all-time high, both of these corrections that happened in the last 5 years were very short in time and very swift in volatility. Matter of fact, you have to go back over a decade to find a true bear market of price decline and time span. Hello, everyone. My name is John Rowland, and I'm Barchart's head of trading education. And I thought for today, what we could do was explore what is a bear market. It's been since a long time since we've occurred one or countered one. So, what makes up a bear market, or what are the phases of a bear market, and how can I recognize them? We'll look at today's major indexes, none of which are in a defined bear market yet, but we could look at maybe discovering that there are some undertones or erosions of prices underneath the surface of some of these major indexes. And then finally, hopefully, with time permitting, I'm going to give you some basic rules, just basic, of how to trade bear markets, and that might be a little bit different from how we trade bull markets or uptrends. And before we get there, please, everyone, welcome my partner and our moderator, Barchart's project director, Jean Baker. Hello, Jean.
Hello, John. How are you?
I am doing fine today. It's finally warming up. We had a little major storm this weekend, so I'm hopefully a little snow melt today. So I'm looking to get outside and breaking the ice, so to speak.
Yeah, get that sun shining. Here we go.
Yeah, because next week I hear it's going to be just as cold, right?
Probably. It's winter.
Yeah, exactly. So you ready to get started?
Yep, whenever you are, John. Fire away.
Thanks. All right, remember today's session is always for educational purposes only, and decisions to buy, sell, hold, or trade securities, commodities, or other investments involves risk and are best made of the advice of a qualified financial professional. And under no circumstances shall we be liable for any loss or damage you or anyone else incurs as a result of any trading or investment activity that you or anyone else engages in based on information or material that you have received through barchart.com and our services. Okay. So, what is a bear market? Now, Robert Ray, in his book, defines it as a primary bear markets are long downward price movements interrupted by occasional rallies that continues until price is discounted, the worst is apt to occur. Now let's read this again. Extended downward price action with corrective counter bull moves that continues until the market discounts everything. In other words, bear markets end only after market prices fall below a line of value. And Ray went on to characterize bear markets in three phases: abandonment of hope, selling due to decreased earnings, and distress selling. So what is Ray telling us with these three different phrases? So first, abandonment of hope. What he's really saying here is this transition of markets from bull uptrends to bear downtrends. And the strategies that bull markets use, particularly buying dips, fails as the market transitions from these uptrends to downtrends. But today's market scholars or technicians will call this phase, where stock ownership is distributed from those who know to those who don't know. In other words, from institutions to speculation, as the distribution phase. As markets move from bulls to bears, as stocks transfer hands from the institutions to the general public. Phase 2 is our selling due to decrease earnings. Now, what we're happening here is we're seeing a change in momentum, a change in sentiment, or the overall expectations of prices, or a lack of appreciation of prices, an increase of pessimism, right? The beginning of fear and anxiety. Plus, what we'll hear is from our corporations in our corporate earnings, a warning of headwinds, or you'll hear something like shrinking margins. But from a technical standpoint, right, we'll move from charts that look like heads and shoulders or double tops, where trends are now turning to the downside. And this is called this continuation of our downtrends, a series of lower lows and lower highs. Now, there is a difference between a bear market, which is a primary downtrend, big picture, and a downtrend. Now, a downtrend does not necessarily define a bear market, but if a downtrend does start to move in favor of our moving averages turning negative, then this is a confirmation of something bigger is going on. So the two classic moving averages that investors look at in the stock market in determining these bigger time frames is the 50-day and the 200-day. But some old-time stock investors will talk about a 30-week moving average. Try it out and see if you think it works. But a 30-week moving average is similar to a 200-day moving average. So phase 2 is the trending phase. Lower highs, lower lows in our higher time frames. And then phase 3 is our distress selling. And here what we're going to find is that price deviates from the declining moving averages. Fear, panic fills our traders' hearts. But typically, there is some sort of liquidation or a major risk-off element as capital is withdrawn from the market. Selling accelerates as investors fear the worst is yet to come, and some are forced to liquidate their positions. Maybe you've heard the expression, throwing the baby out with the bathwater. Or in classical aspects, if I ask somebody, a man on the street, what is a bear market, most folks would say this part of a bear market, that crash, right? That final leg of a bear, right? A disregard of value, right? Sometimes you'll hear folks are having to sell winners to pay for losers. That capitulation. Okay, so that's kind of the three phases. So what I want to do is I want to go and look at this last bear that we had back in 2006, 2009. And I want to see if what I just explained to you plays out. Now, before I do that, I do want to show you a feature on this chart. And this is kind of what we want to use this feature if we're going to be looking at, let's say, a much greater time frame, or if the stock, or in this case, an index, has a large price movement. In our settings, we have something called our scale. And what I want to do is I want to change my scale to a logarithmic scale. Now, what a logarithmic scale graph does, the vertical distance in price is an equal distance. For instance, let's say I had a stock that was trading $2 20 years ago, and it went from $2 to $4. That'd be 100% price movement. But today, that stock is a $100 stock, and it goes from 100 to 200. Again, 100% price movement. A logarithmic chart will show those price movement in the percentage as equal distance on the chart. If I change this back to a linear chart, notice that our big 57% movement here is much smaller than our 35% movement there. But if I change it back to the logarithmic, now the scale is correct based on the percentage. So just a little trader's advice here. If you're going to look at a stock that has moved a great distance in price or over a longer period of time, try out this chart scale and see if it doesn't give you a little bit of perspective. Okay. All right, so what we're looking here is at the SPY back in 2006, 2009. And what I've done is I can go back in time and look at a very specific time frame. All I have to do is go into the calendar here and type in the time frame that I want to look at. In this case, what we're looking at is the SPY between March of 2006 and June of 2009. So here we can see that bear market playing out. First, our phase one, our distribution phase, where our bull trend strategies start to fail, right? Buying dips are not working, or that we're not making new highs. Here we're kind of seeing prices kind of moving from an uptrend to a sideways trend. The red line here represents our 20-day moving average. And as we move into phase two, the trending phase, right, we now see our higher time frame moving averages starting to turn negative. But also, if we think about trends, in the case of a downtrend is defined by a series of lower lows and lower highs, lower lows and lower highs, lower lows and lower highs. And so we're in the trending phase. And then finally, the last phase is that distress selling, or the capitulation phase, right? Where price accelerates far from our moving average and it falls very fast and very hard. Maybe some of you have heard the expression that bull markets take the stairs and bears take the elevator. And again, what I said is classically, most people think of that crash as a bear. But what we can really see here is that crash, or that capitulation, or that elevator ride down typically is actually the end of a bear market. Now, I remember this time, and I was working on the NYMEX at the time, and some of my large institutional customers, our commercial customers, what was happening was every day, a lot of them were coming in and were liquidating their futures positions in natural gas, even though a lot of them were winning positions, because they were being told by their compliance officer that they had to take risk off and raise capital, selling winners to pay for losers. And every day we'd wake up on Monday morning, you'd read about another company that went bankrupt or that had to shut its doors. And so there was a lot of depression, a lot of fear, a lot of anxiety in the market, right? And prices continue to fall, not only fall, but fall hard and fast. Okay, so that's kind of the picture I want you to start watching for or looking at in terms of what a bear market looks like in a big picture over a longer period of time, these different three phases. So let's go and look back at our current indexes, now here's the S&P again. And again, this market, you can see, is not in a bear market. We still haven't fallen 20%. Matter of fact, if we drew a trend line.
Yeah, while you're getting that chart up, just had a few people, I just want to verify on the SPY chart that you had up, you're using a 200 period moving average.
That's correct. That was it. Yeah. The red line was 200-day moving average, yes.
Right, great. Okay, thank you.
So again, if we look at our SPY here, you can see that we're still, we're still in an uptrend. We are continuing to test that uptrend, but if I'm using a buy dip strategy, I'm still getting rewarded. Although today, we're kind of, depending on how you draw your trend line, we're right on. Again, we're testing that potential trend line, but certainly we have not fallen 20%, which would signify or be classically defined as a bear market. If I look at the NASDAQ, again, we can see we're still in an uptrend, but we are starting to see a little bit of change here, aren't we? Not only are the most recent dip buying failing, but we're now starting to make lower lows. So is this the transition from an uptrend to a downtrend? Well, in this picture, it certainly does look like it. Is this a bear market? Maybe not. Maybe this is just a correction inside of a larger bull market. But if we go to, let's say, the Russell, we see a different picture here. We definitely see that area of distribution where the market trades sideways for a longer period of time. In this case, Russell has been in this area of distribution for almost a year now. You can see that as of recent, we did break out. And if we were in a bull market, that breakout should have been rewarded. In other words, prices should have continued higher as we made that new high. And then price failed to continue to go higher, and not only failed, but it fell back inside of that area of distribution. Now, typically, on a technical standpoint here, when you see a breakout, fake out, and price moves back into an area where it was gathering energy and trying to move higher, you will typically come back and test the lower end of that range, and that's exactly what the market did. But then, from that point on, we did not make a new high. And you can see today, we're actually outside of that area of distribution. So could the Russell be telling us that it's just completed the first phase of a bear market, or that transition from bulls to bears, and now we're going to start the downtrending cycle? It's hard to say at this moment, but it certainly does look like that. So one of the things we said as we move from phase 1 to phase 2 is this market sentiment. And there's a couple different ways we can look at market sentiment on Barchart. So one of the easiest ways we can look at market sentiment is something called the momentum page. And this is a snapshot of what is going on today. And typically what we can do on this page is we just want to look at advancing shares versus declining shares. Again, if I'm in a bull market, we should see more shares advancing versus declining. If I'm in a bear market, we're probably going to see more shares declining than rising on a day-to-day basis. We can also look at the volume in terms of up volume versus down volume. But what we really kind of want to look at is the big picture. And in this case, we're going to look at our 52-week highs and our 52-week lows. If I'm in a bull market, I should see more stocks making new 52-week highs and not making new 52-week lows. So if we just look at the snapshot today, we do see that we are making more lows, 52-week lows versus 52-week highs. For the New York Stock Exchange, it's 3-1. If we look at the NASDAQ, it's almost 25-1. So certainly market momentum for today is giving us a bearish overtone. The other thing we can do is we can go into the stock performance page as a way to look at market momentum. Now, when we come down to these grids here, what we're looking at here is the number of stocks that are above these different moving averages. And again, I want us to concentrate more on the indexes themselves and those two that I just mentioned, the 50-day and the 200-day. So let's first start with the S&P 500. You can see that about 60% of the S&P 500s are above the 200-day moving average, right? We're still in that uptrend. But if we look at our 50-day, we do see now it's only 49% or about 50%, a much lower number. And if we look even a shorter time frame, the numbers get smaller. So with the momentum at this moment is telling us that the S&P is starting to slow down and that more stocks are starting to turn downward than turn upward. Again, this could just be a correction phase, but this could be also the beginning of our bear market. If we look at the Russell, notice that here we see a different story. 40% are above the 200-day moving average. That means 60% are below. And if I look at the 30-day, right, only about a third are above their 50-day and 2/3 are below their 50-day. And if I look at a very short period of time, only 15% of Russell stocks are actually in a short-term uptrend. Look at the Dow, we see something similar to what we saw in the S&P. And if we look at the NASDAQ down there at the bottom, again, only 50% above the 200-day moving average, only 25% above the 50-day moving average. So let's just kind of go in the S&P for a second. And what I wanted to kind of show you here, which is kind of interesting, and I found when I was digging through this, putting our webinar together. There we go. If I look at the market cap of the S&P 500, the top 6 stocks in the S&P 500 make up 25% of the market capitalization of the S&P 500. So what is really going on here is that, yes, the S&P is holding its own, but it's really based on these 5 companies. If I go into a charts and I look, for instance, at some of the names that you're familiar with, for instance, let's look at Apple here. Right, still in an uptrend, but are we seeing that distribution phase? If I look at Microsoft, again, still in an uptrend, but we are starting to make lower lows. Have we moved from distribution, starting that downtrend? Google, same thing. Looks like we're still in that distribution phase, right? Bull strategies might still be working. Now, if I move just a little bit from those top 5, let's say NVIDIA, right? This has definitely been one of the larger big caps that has been appreciating over the last year or so. It's certainly one of the ones that has been driving our market. We can see that this one is actually in a bear market. It is 20% off of its highs, and certainly looks like we're in that trending phase. If I go outside, let's say the top 5 or 6, I look at, for instance, Visa. And again, when we look at price action, this looks very like a head and shoulders. And when price broke the neckline, we started an acceleration of price to the downside. Now, we did make a low, and we make it high, but we didn't make a new high. So we're making lower lows and lower highs. So are we in the trending phase of a potential bear market? Now, Visa is not down 20%, but certainly it does look like it's starting to make that process. And let's just look at one more. This is Disney. Disney is definitely below 20%. It's definitely in what we would define as a bear market. You can see that nice distribution at the top. Once we broke out of that range, we really seen an acceleration of price. And in the last few weeks, this could be a bear flag or a continuation, right, of our potential downtrending market. Now, there is one other way we can look at market sentiment, and it's a little bit outside of the box. But I can go into options, and under the market overview, over here on the right, what we can look at is something called the put-call ratio. And how we read this is a value based on how many puts are being traded and versus how many calls. So if there's an equal number of puts and an equal number of calls, we'll see a put-call ratio of 1. Now, typically in bull markets or trending higher markets, retail investors will buy more calls or trade more calls than they will puts. And so typically what we'll see is the put-call ratio is below 1. Somewhere between 50 and 60 is typically what we will see. If I'm looking at the put-call ratio for indexes, institutional traders will tend to use indexes as insurance. So we'll see the put-call ratio above 1. They'll trade more puts because it's easier for them to protect their portfolio trading one contract instead of buying individual puts for each one of the different stocks. Now today, it's not bearing out, so to speak, a bear market. Now that might be because we are having a dip in the market and retail investors are starting to buy that dip. In other words, buying calls in anticipation that the market is going to rally. But if you were watching this over the last few days, or actually over the last few weeks, both of these put-call ratios, the index put-call ratio and the equities put-call ratio, was at the high end of our 52 range. In other words, the sentiment over the last few weeks has been more bearish than bullish. Now today, we're kind of right in the middle of the range for the equities. Typically, when you get above about that 0.70, that is definitely a bearish indication. And for the indexes, it does look like there are buying more calls today. Again, they might be buying dips. But this one has been carrying a much higher put-call ratio, about 1.5 or 1.7. Right. So that's another way we can look at market momentum. All right, so what I did was I went back to our market screener as I was putting together this webinar. And have you ever been to like the beach and you built a sand castle and you built it kind of close to the water's edge, and as the tide kind of rolls in, each little wave kind of comes up to your sandcastle and starts eroding away from the bottom a little bit more, and then eventually, right, the whole castle collapses. So let me show you what I've discovered. So I'm just going to screen on our larger indexes, and I'm going to start with the Russell. And what I want to do is I want to see, in terms of our highs, how many stocks are from or outside 20% of our 1-year high. And if I check that result, the Russell 2000, 1,281, right? About 60% are off of their 20% off of their 1-year high. All these stocks classically are in bear market mode. If I go to, let's say, mid caps, and look at the same result, look for the results. S&P mid cap 400, 140, a little bit more than a third of the mid caps are in a bear market. And if I go and look at the S&P itself, 500, only about 25%. We saw that on our chart. So still, a lot of stocks are still probably in what we would consider maybe an uptrend or a sideways trend, but here we do see a quarter of the S&P is in bear market territory. So what I did was I kind of just said, let's eliminate a lot of these little stocks. Let's get rid of the high value stocks or the high multiple stocks that we find in the NASDAQ. And let's kind of just look at the big picture, big large caps. And again, I just wanted to see how many. And there's about 1,100. Now, what I did was I went and looked at almost all these, not all 1,100. I do love you folks, but I've looked at about 700 of these. And then what I did was I just picked out some examples of markets that are in bear mode and looked at see if we can see some similarities to those phases that we discussed. And so what I did was I created a watch list of these examples. And the first one here is Western Union. Now, what I like about this one is if I was going to create a textbook of the transition or the cycle from bull market to bear market, and then show all three phases of a bear market, this would be the chart I would show, right? This all happened in a 1-year span of time. First, you see our uptrend, right? Our buying dips is working. We're making higher highs and higher lows. Then we enter the area of distribution, and not any distribution, but on a classical technical analysis, right? A very beautiful looking head and shoulders. Once we broke that head and shoulders neckline, well, what did we start? The trending phase of our bear market, and then followed by that acceleration, discounting everything, our capitulation, bottom of our bear market. And you can see now that Western Union is starting to trend up. So again, one of the things we can look for in bear markets, if you're waiting patiently, waiting for that capitulation, waiting for these micro crashes, this could be the signal of our new bull market. This is T-Mobile. Again, distribution here, a little bit of a head and shoulders, maybe not well defined, but you can see once price broke through those most recent lows, we started the trending phase, and maybe we are seeing two capitulations here, or maybe this is just a continuation of our trending phase. There's Charter Communications, a lot quicker change in price, but again, right, it looks like a little shoulder there. There's a head, there's a shoulder, there's our neckline where we get close to that 15-20%, and now we're in the trending phase, right? Could we be starting the capitulation on this gap down? Yeah, maybe, but maybe this is just another wave in a downtrend. Lululemon, another common stock. Again, This one is below 20% in a bear market. And you can see that distribution top, and now we're in the trending cycle downwards. Here's Restoration Hardware. Now, this is an interesting stock because this has been one of the darlings of Wall Street for the last 2 years. This stock has gone from $100 to $700 in a 2-year period. I mean, that is extraordinary gains. But there is our area of distribution. And once we finally broke out of that, once we broke below 20%, now we're in that trending phase. Now, we do see prices accelerating quickly here in recent weeks. Now, could this be the beginning of our capitulation phase? Maybe, yeah. Certainly looks that way at this moment. NVIDIA, again, that one of those large big cap stocks that has been helping hold up the S&P, right? Off 20% from our most recent highs, and certainly if I look at this channel, we are in a downtrend based on this channel. Now we are at the bottom of our downtrend, so as Ray said to us, could we see an occasional rally? And certainly we might see a rally in this particular stock, but certainly probably won't see it get above, or at least above 300 anytime soon. If it did, then that could be the signal of a new uptrend. Uber. And again, as I'm walking through a lot of these, you guys should be sort of visualizing this. The patterns are a little bit different, but they're all kind of showing the same message. Now, one of the things I thought about this Uber example was, here's our area of distribution, and here's a classic pendant, what we talk about in chart patterns in technical analysis, right? We have a higher lows and lower highs, right? An area of consolidation. We're ready to spring out one way or the other, and we get that breakout, right? That's usually an indication of a continuation move, and yet we did not continue up. Matter of fact, we failed to get above a previous high. And if we look at this across the board, this was a triple top high. And like I said before, a lot of times when you have a fake out breakout, price will fall back and test the lower end of that previous range. And that's exactly what it did. And when it broke that low, well, then we moved from the distribution phase to the trending phase of lower lows and lower highs. Now, it's not all doom and gloom, right? If you can see this pattern play out in your stocks, this is a stock that we actually showcased a couple of weeks ago in our Traits of Traders, Successful Traders Traits. And you can see here's our double top distribution, very common, right? There's our kind of our neckline, so to speak. That's where we broke down. Now we're in the trending phase. And then there's that capitulation, right? That swift and violent sell-off, and a nice V bottom. And we've now, looks like we've bounced back up. Here's Deluxe Industries, Deluxe Corp. And I really love this example. Again, there's our distribution phase, triple top, very rare. Don't see a lot of triple tops in markets, although I did show you two. But here is the clue. Right? We made a new high, and we made a higher low. That is part of an uptrend. Then we came and tested the high. We didn't make a new high, but we tested it. But then what did we do? We made a new low. Then we went back and tested the high a third time. And we came back and made a new low. So this would have been the clue that we were in distribution and that something was happening in this market. In other words, we were transitioning from a bull. Our bull buy dip strategy is not working, and now market is telling us it's about to start a new trend. And then once price broke this new low right there, that was the beginning of our downtrend phase. Now the question here is, this one little candle, could this be a capitulation for this particular stock? Yeah, maybe, right? This is an island reversal. Sometimes you hear this is a hammer or a morning star. There's a lot of different ways you could categorize this, but this is usually a sign that the market has overextended itself in a very short period of time, that sellers overwhelm the markets, and then they are satisfied, and then once selling dries up, market snaps back. But it could still be in a downtrend, and this is just a little bit of a short correction in our trending phase. And then finally, let's just end with one more, because I'm getting a little bit late here. I want to make sure that I get to a few more things. This is Telflex. This is actually a pharmaceutical company. They make one-time use surgical materials. And again, you can kind of see our head and shoulders here. There's our neckline. There's our trending phase, our distribution, our trending phase, and there's that acceleration, that capitulation, and now we're kind of trading sideways. Now, if I was looking for a bull market out of this one, well, what do I need to see? A new high and a new higher low. We're not there yet, but it certainly looks like for the time being, we are starting to move in a corrective phase from this previous downtrend. All right.
No, so, John,
yes.
I'm sorry. I'm going to interrupt you for a moment because I've had a number of people ask me how you draw your downward ray to show the percent, the 20%. Just stay on this chart. Just show us how you go about doing this. I think that'll help some people here.
So I can find tools over here on the left of my screen, or I can open it up here, right? And I want to open up a ray. Now, first what I want to do is just draw the ray, right? And once I draw the ray, then I'm going to right-click on the ray, and I can change, I can design it by values that I know. I can change the color, right? There's a lot of things I can do, but what Gina's asking me is I'm just going to click on where it says show prices and show percentage. Now, if I want to put an arrow on it, I can do that as well, and apply, and now it shows me the distance, the two prices, the high, the low, and the percentage change. Okay, in this case, looks like our stock, Teleflex, has fallen almost 35% from its most recent high. Okay. All right, so let me pause here for a moment. I do want to leave you guys with a couple parting. I do want to talk about some rules for trading markets from the short side now that we see what we're looking for. I do see a couple questions here. So let me pause here a second. Any questions that are sticking out, Gene, besides the one that you just asked?
No, the one that I just asked. Let's see. Well, why don't you review your questions? There's a couple people asking about whether this is recorded, and yes, it will be on our webinar archive page a little bit later on today.
All right, so I see Jeffrey was asking about the ray, a couple of rays here. So Aaron was asking about our put-call ratios between bonds and equities. If we see that shift, seeing more puts in equities and more calls in bonds. And typically, Aaron, yeah, in classical market movements, when equities start to fall, there's a feeling that capital will go into safe havens, into bonds. And we have been seeing that of recent, right? For sure, secure rates of return. But I also kind of remember that this has been skewed for a long period of time because of quantitative easing and an inflation, the inflated security prices of all security assets, stocks and treasuries. But yeah, you will see that in terms of your market sentiment. So Ted is asking how you distinguish between a correction and a bear market, and that's a great question. So Ted, again, those two elements, that distribution where we're seeing price changing, where our bull strategies fail, right? In other words, dip buying doesn't work anymore, and the big key is that rollover of our moving averages, our higher time frame moving average, that 50 and 200 day, right? I see a question here, should we look for 20% on stocks or indexes? So again, it depends on how you define bear markets. The classical definition is 20% off the highs. Personally, I feel that if you can get through a significant area of support and the stock has moved 15% off of a high, that to me would be a sign that I'm probably starting a downtrend. Again, there's a difference between what could be a downtrend or a corrective phase in a primary bull market, a much bigger picture bull market, than in a bear market. And the key there again is seeing prices below those moving averages and those moving averages turning negative. That would be the indication that we moved from a bull market to a bear market. Okay, so some great questions there today. All right, so let me go back to my slides here. And I want to just give you some basic rules. Now, I am running a little bit out of time, and I know that we described in our session that we were going to talk about this, but this is what I'm going to do for you folks, is I'm just going to give you some basic rules today, and what we'll do is we'll come back maybe in March if we are seeing a bear come out of hibernation, so to speak. We'll come back and we'll look more in details about some techniques, how to trade markets from the short side, or how to trade bear markets. But let me just give you some basics. First of all, is my market in a bear market? That is a key for us. I don't want to be shorting markets or in bull markets, right? That's a disaster. That's a recipe for disaster. But if I'm in that distribution phase or that sideways process in the larger indexes or in my particular stock, again, I probably want to wait for those technical signals that confirms to me that we are in the process of becoming a bear market. If I'm looking at indexes, and now what I can do is I can be a little bit more granular. I'm going to pick on those sectors that are weak, right? Pick on the weak sisters, so to speak. Those ones are the ones that have already turned. So look for the stocks that are in those weak sectors. And then I'm going to look for those chart patterns that we just described. First, those head and shoulders, those distributions, those double tops, those triple tops, right? And then when price breaks those necklines, when the price breaks those most recent lows, as we start that trend phase, that's when I'm more inclined to look for shorting opportunities, when I know my market is in a downtrend. And again, a way we can confirm that is looking at our higher time frame moving averages. Another thing that we can do, and we'll talk about this a little bit more in detail sometime in the future, is look at relative strength of our individual stocks or sectors versus the larger market. We're going to look at counter trend entries. Remember, Ray talked about these occasional bull rallies in the bear market. That's what we want to wait for. We don't want to be chasing price on the way down. We're going to wait patiently for those bounces, sometimes referred to as dead cat bounces, right? We want to wait for those bull corrections. Many times in a bull market, you'll hear buy the dip. Well, we're going to change our philosophy. We're going to sell the rip. In other words, we're going to wait for those little bounces, looking for opportunities. Now, what this does for us, waiting for those opportunities on those bull corrections, is it does help us lower our risk and help us define risk rewards a lot more profitably. And then finally, we want to look for trading opportunities where we believe there's a path of least resistance. In other words, room for market to run. As prices are falling, where's the next support level? Now, if I'm in a bear market, I don't need to fear a most recent low because I know in a bear market, I'm going to make a new low. I still need to respect that low when I do my risk reward analysis. But below that most recent low, is there room for my market to run? And the greater the room, the greater the potential for that particular trade. Okay? So I do see Lawton's asking something. It says, besides the technical sides, right? You said that so many significant headwinds in terms of fundamentals, rising interest rates, inflation, supply chains, right? Bad Fed balance sheet, et cetera, et cetera. Lawson, awesome. I love when folks ask me questions that leads to my next segment. So I want to leave you guys with a parting thought. Those who don't learn from history are doomed to repeat it. In other words, I spent all this session showing you what a bear looks like, trying to give you that visualization. Look at those steps, those phases. But in my research, as I'm building this webinar, I happened to stumble across an article from the Wall Street Journal from 1907, that describes the determining factors of the great bear market of 1906 to 1909, over a century ago. And what I want to do is I want to read you these determining factors. And as I'm reading them, I want you to think about what is going on currently. And then we'll have a little discussion here at the end. So 1, excessive prosperity. 2, high cost of living. 3, adjustments of value to higher rates of interest. 4, speculation in land absorbing liquid capital that might otherwise be available for commercial enterprises. I don't know about you guys. Has anybody ever tried to look at buying a new house recently? I have for the last year, and prices continue to go up, 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 and up. Roosevelt's policies of government regulations of corporations. Progressive socialistic sentiment and the tax on wealth. Overproduction of securities. Did you guys know that in the past year it was the highest number of IPOs in dollar values than we saw in the dot-com bubble? War between big financial interests, central banks. And then finally, the effect of the San Francisco earthquake. Now, how many of these attributes that I just mentioned are kind of being played out today? All except for our black swan event of the San Francisco earthquake. But what could be our black swan event? Or what could be that tipping point that is going to change our 10-year bull into a bear? Maybe that tipping point has already happened, right? Only time will tell, or you will make that decision, or scholars will make that decision. So I hope you guys liked the presentation today. Again, I'm not predicting the market is in a bear, but certainly the evidence of the market overall is telling us there's a lot more bearish activity in individual stocks and some of the indexes. And bear markets aren't bad. They're good. They're good for markets. It's healthy for markets to have bear markets. It gives us an opportunity to reevaluate value, look for cheap assets. And again, one of the things I want you to kind of look for, if you recognize a bear market, wait for that capitulation and see if that is not a good buying opportunity. All right. Anything else, Jean?
No, other than talking about what's up for next week.
Okay, great. So next week we're going to shift gears a little bit. We haven't done an options segment in a while. So we're going to look at selling secure puts, or in other words, naked puts. And we're going to look at this in terms of a little bit different aspect than what you would normally think about naked puts. What we're going to do is we're going to look for opportunities in markets, for instance, in those capitulation phases where investors are rushing in and buying puts and raising the valuation of puts. But what we're going to do is we're going to sell those puts to them because we believe, or our intention is, we're going to buy that stock at a value that we've determined, and what the selling that put is going to do for us is going to even discount the purchase price of our stock. So we're going to look at how to discount an entry into the market by selling secured puts. So I hope you guys join us for that session next week. Okay.
One thing, while John has this webinars page up, I'd like everyone to take a look. There's a little subscribe button to YouTube, upper right corner. Barchart does have a YouTube channel where all of John's webinars are also archived. And if you subscribe to our channel, you'll get notified every single time we post one of these webinars to both our webinar archive and to YouTube. So,
and on that note, a lot of the things that I've showed you today, for instance, again, help me with this, Gene. I think our stock screener is a premium feature. Is that correct?
No, well, Stock Screener is available for free members, but premium members, I mean, you can set up that screener that John showed you earlier where you can search for stocks that are 20% off the 52-week high and have that screener automatically run and sent to you each day via email. So there are a lot of things available with the Premier membership having to do with screening for the kinds of patterns that John presented today.
So yeah, take a chance on us. I think you guys will enjoy it. Those of you who are not members, you have a chance to try out some of our premium features for a 30-day free trial. But again, you can become a basic member and it'll get limited access to some of the features, but a lot of the tools and pages that we talk about, you'll have access to them. So become a subscriber, become a part of our family, and see if it doesn't improve your skills, your trading, and your investments. Okay, until then, I want to say, be safe out there, be healthy, and the good of all trading.